Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Welcome in to another Healthy, Wealthy, and Wise Retirement. Of course, I'm your host, Lauren Sherman, and today we're going to be sharing the conclusion of my talk with Dr. Wade Pfau. If you did not catch the first part, go back just one episode and have a listen to that first, as that will set the stage for today. Last time we talked about Wade's retirement planning tool called RISA, or Retirement Income Style Awareness, which, just as the name implies, this helps people understand their personal income style so they can find a retirement strategy to match. I was talking about the RISA with a client recently, and the comparison that helped them make sense of it happened to be that they recently purchased a new truck. So we use their car buying experience to explain what the RISA is. It's not a perfect analogy because usually when people go to buy a vehicle, they have a pretty good idea what they need it for. But at any rate, think about the person who lives on a farm and they're going to need something that can haul a lot of stuff or even pull a trailer on occasion. Obviously, a truck is going to be a good fit for that person. On the flip side, let's look at a person living in the city with a few children or grandchildren, and maybe they're often transporting them from activity to activity. They might need an SUV or minivan, perhaps even an electronic or hybrid for better mileage. Then take the person who lives and works in downtown New York City. They might just use a bicycle, Uber, and public transportation to get around. And of course, the analogy wouldn't be complete without the last of the four quadrants, which is the guy with a sports car who is single, no kids, and just wants to impress the ladies. So vehicles, just like with financial strategies, it's not necessarily that one in particular is best. It's simply a matter of finding the right fit. I kind of laugh to myself as I say this because Wade is this brilliant academic who has a doctorate in economics, and here I just reduced his research down to a car analogy, but hopefully he approves and the comparison helps at least a few listeners. So in part 2, we're going to have some rapid fire questions for Wade. We talk about annuities and their place within financial planning. We cover another sometimes controversial topic of reverse mortgages. We talk about buzzwords in the industry and what is really important to investors. And then finally, we wrap up with some tax-related listener questions. So with that, let's go ahead and jump back into my conversation with Wade Pfau. So I'm going to fire a hot topic at you right out of the gate then here for part 2, I guess we'll call it. The topic of annuities, we've already touched on a little bit, but for so many, it seems, and maybe I'm just seeing this in some of the groups that I'm involved in, but the word annuity kind of seems like a 4-letter word to some. There's even a marketing pitch out there. I hate annuities and you should too, right? So I think the disconnect to me is that people tend to love receiving their Social Security check. If they're fortunate enough to have a pension, they love to have their pension every month. So I guess maybe that's a long-winded way of just asking, where's the disconnect there of people kind of love what the annuities are, but there's so much turnoff of the actual word and maybe the product itself.
And to be clear about that marketing pitch, that I hate annuities and so should you. It is just a marketing pitch. The person who runs those commercials I've heard speak at a conference where he freely admits that's not like his belief. It's just this is his gimmick for running advertising for his investment management firm. But yeah, annuities definitely do have a bad name, and part of that is it's possible to abuse annuities for the advisor selling annuities to abuse the process and maybe taking advantage of people at advanced stages who may not have their full cognitive abilities and who may not necessarily need the features that the annuity provides. But if we can step away from that a little bit, just the idea of the annuity, like you're saying, traditionally, it exchanges a lump sum for a guaranteed set of payments that typically will be for a lifetime. So it behaves much like Social Security, much like traditional pensions. And where did the disconnect happen? I think partly it was just since the 1950s, increasingly with the way the taxes are done in the United States, lobbying to make annuities as a tax deferral vehicle, where suddenly you're just using it to avoid taxes rather than using it for the traditional purpose of getting this protected income. And you may not have any intention of using it for protected income. And that just led to a bunch of complications. Actually, I mean, I spent 10 years living in Japan. And at one point there, someone asked me like about this idea that they said, in English, there's these two different words, pension and annuity. In Japanese, we only have one word for those concepts. Why are those two different names? And the best answer I can come up with is in the US, annuities just became more complicated tax deferral vehicles, and in many cases lost sight of their original concept of they were a pension, they were a protected lifetime income. And so I do think that's what led to some of this sort of disconnect where people really love, like you said, Social Security, they love traditional pensions.
Yeah.
But just when they hear the word annuity, they think it's something bad.
Well, and I think probably, to be fair, some of that has been rightfully earned, right? Because like we were mentioning before, the term advisor is so loosely regulated that a lot of people maybe were out there offering annuities as the one all be all. That should be their retirement plan and that should be their whole portfolio. And, potentially they were after maybe more of the commission check than the client's best interest. So there's some of that. But then I think often what we end up hearing is all of the negative things all combined into one. So you hear they're really expensive. There's huge commissions that you pay. It's a one-time locked up decision. It's irreversible. And you end up kind of with all of these wrapped into one where maybe they're grabbing a little piece from all these different types of annuities and grabbing the worst thing about them. So there's just a lot of, I think, misunderstandings out there in general.
Right. There's this Frankenstein annuity that combines all the bad. There's many different types of annuities, each with advantages and disadvantages. But this Frankenstein annuity just takes the disadvantages of every type of annuity and puts it together.
Sure.
And so that's right. Like if it's an irreversible decision where you don't have any, you kind of lock it away forever, those are income annuities that typically have very low expenses. If it's a high cost annuity, that's usually referring to a variable annuity, which is reversible. There may be surrender charges, but once you get past that, you have full access to the underlying value of the annuities. So those are two completely different types of annuities. And when you say you make this irreversible decision and it's high fee, you're now taking the negative aspects of each of those and putting them together into something that doesn't actually exist.
Yeah. I just know when I saw you speaking or writing about annuities, it really catches my eye because you really do so with such an academic rigor that you're coming at it maybe from a different perspective than obviously like on the other extreme, an insurance company trying to get you to sell an annuity would have the incentivized to have a certain position. So I think it's good for retirees as a whole to see this from an academic rigor. But as a follow-up to that, I guess maybe I can throw in another one where potentially you're a little against the grain than or maybe they've just gotten a bad name, but reverse mortgages. Can you speak to those a little bit?
Yeah, I get a lot of tomatoes thrown at me. I can speak positively about both annuities and reverse mortgages. And to just step back from that a little bit, it's really the reason why is retirement, risks change in retirement. We've all gotten used to accumulation. When you're growing, when you're saving, you're working during your working years, you're setting aside savings, you're investing that, growing that money for retirement. Then you get to retirement. Now the problem changes. You're no longer working. You have your accumulated savings, but now you have to spend that over your lifetime in a sustainable way that you're not going to run out of money. And there's risks with that. You don't know how long you're going to live. There's this thing called sequence of returns risk, which is if the market goes down, but you're forced to sell from your portfolio to meet your expenses, that digs a hole for the portfolio that even if the market then recovers, your portfolio won't get to fully recover because you're spending from it. You're spending from a declining portfolio.
Right.
And then there's all these different spending shocks that can happen where you have these surprise expenses that are true pre-retirement as well. But when you get to retirement, healthcare can become a bigger issue, long-term care expenses, having to help adult children, adult family members, and so forth. There's many things that can happen. And so how do you manage these risks? And that's where both annuities and reverse mortgages can be very effective tools as part of a plan, not just by themselves in isolation, but as part of an overall plan to produce better retirement outcomes.
So without giving specifics that would be like considered a recommendation, can you just generically speak to maybe who a reverse mortgage, roughly who would that be a better idea for, and who maybe potentially it would not be a great idea for?
Mm-hmm. Well, so there's a lot of advertising for reverse mortgages, and that's usually focused on the last resort option, which is you've run out of other options. The only thing left is to consider the reverse mortgage. And it may make sense in those cases, but that's not really where my focus is. When I talk more about who might it be appropriate for, it's more, there's this growing line of, well, so with reverse mortgages, there's the home equity conversion mortgage. This is a federally administered program that accounts for about 90% of reverse mortgages in the US. There are also proprietary and jumbo reverse mortgages that exist outside of that. Within the 90%, I'm talking about the home equity conversion mortgage program, they have a growing line of credit that has protections that you have full access to that. It can't be taken away. The HUD insures it for you. So that opening that earlier in retirement when you anticipate staying in your home and just using that strategically as part of the retirement plan in many different possible ways, those are the cases or the candidates where it may make more sense. So you can't do that till you're at least 62. If one spouse is older than 62, the other is younger, that younger spouse can be a non-borrowing spouse. But if you're close in age, it may make sense until you're both 62. And then beyond that, you do anticipate staying in the home. You might move someday, but if you know you're going to move in the next few years, you should probably also wait. But once you're in the home that you anticipate hopefully staying in over the long term, it's just worth having a look at whether that growing line of credit creates liquidity so that you can spend from your home in the same way that you can spend from your investment portfolio, whether being able to strategically use both of those can lead to better outcomes. And that's the research I've done is just, yes, the synergies you can get from strategically tapping into your home equity throughout retirement can lead to better outcomes. Retirement outcomes. You can meet your spending goals more effectively and preserve more for legacy net of the loan balance. After the loan balance is repaid, you still have greater net legacy for your heirs at that point.
So you're almost looking, if you're like thinking of your retirement assets as a pie chart, you're kind of including your home as part of this retirement income strategy in some ways is what you're doing, right?
Right. And for the average American in their 60s, the home equity is like 2/3 of their, well, like the investment portfolio is 1/3, home equity is the other 2/3. So for most people, their home equity is much larger than their investment portfolio. And the traditional retirement planning advice is ignore home equity or just sort of treat it as that last resort. And time and again, consistently, I find that that's the least effective way to incorporate home equity into the plan. If you could do it more strategically from the beginning, you can set yourself up for a better outcome.
And correct me if I'm wrong, but even if you end up taking out more out of that home, you're not going to pass along a debt to your kids or your next generation because of the insurance protection that's built in, right?
Right. Yeah. It's called a non-recourse loan. And also one basic misunderstanding people have, you don't lose the title of your home with the reverse mortgage. It's shocking how people don't understand that detail. So you still own your home. If you're borrowing from it, there will be a loan balance, but it's non-recourse, so that if the loan balance grows to be worth more than the home is worth, when it comes time, when you've left the home, it becomes time to repay the loan balance. Your heirs or your beneficiaries are not on the hook for the full loan balance. They can effectively, if they wanted to keep the home, which they probably don't in most cases, If they wanted to keep the home, they'd have to just refinance it into or pay off the debt. But it's only up to the value of the home. And if they don't want to keep the home, at that point, they could just turn over the keys and not have to worry about selling it and everything else. If the loan balance is still less than the home is worth, then working with the lender, they can have up to a year to decide either that they want to sell the home to repay that balance, or they want to get a mortgage to pay that balance and just convert it into a traditional mortgage so that they can keep the home as well.
Which potentially could make some sense because they could just turn around and sell it if the loan's not as much as the home value, right?
Right. Yeah. A lot of times I think people think their kids want to have that home, and that's often not the case. But in terms of this research, even if it was the case, the whole point of my research is by being strategic so that you're not always just spending from your investments, you can help weather market downturns for your investments so that your investments will grow by more than the loan balance. So that your beneficiaries, your children or whoever they are, can pay off that loan balance and still have more, a windfall beyond that, because they've used a more efficient strategy. So yeah, it's like I'm going to have a bigger investment pile because I'm not spending everything from the investments, because some of that spending is coming from the home equity.
Right.
And then the gains to my investments more than offset the costs of the loan.
We could probably have a whole separate conversation just on that. But one of your books was specifically dedicated to reverse mortgages, right?
Right. Yeah, that was, so my first book was on reverse mortgages. And that was that first example of, I didn't know much about reverse mortgages. I first started learning about them in 2014, because I kind of had the same idea everyone has, that these are not all that helpful. I should look at it someday, but I'm not in any hurry. And then when I did start looking at it, I became fascinated by it. And so the chapter I was writing on reverse mortgages got so long that it was an actual book. And so the first book I wrote was a shorter, it was kind of to get the experience of how to publish a book, a shorter book on reverse mortgages. That was my first book. And I do update that one every year as well. So it's, I'll update it in early 2024, but the current edition it came out earlier. When did it come out? The first part of 2023.
I'll throw another kind of hot topic or word out there for you and hear your thoughts. So the word fiduciary is a little bit of a buzzword in our industry, as is the term fee only. But in my opinion, I guess to leave my opinion out of it for a second, are we focusing on the right things or the wrong things when it comes to those terms? Particularly, I'm interested to hear what your thoughts are on fee only, because it seems just from the outside looking in that they would be a little bit limited with some of the options within your RISA styles.
Yeah. I think the fee only in the conventional wisdom now, fee only is treated as the good guy, but it's really that it's in retirement's different. In the accumulation world, the argument about fee only is, so I only accept fees from the client. I don't accept any sort of commission for selling any financial products. Fee only often works as an assets under management model, which is I'll charge a percentage of your assets as my fee, and then I'll manage your investment assets for you. And so then the story is, if you do well, I do well. Like if your portfolio grows, I will get a higher fee. And so our incentives are aligned. I want to manage your portfolio to grow more so that I can get a bigger fee. And the argument is that aligns in the best interests of the client to grow their asset base. But like you even said earlier, if the advisor has a different risk tolerance than the client, that doesn't necessarily align the incentives properly, because the advisor might be willing to take on more risk because they want to grow that portfolio more so they can get more fees, but they're taking more risk. And if there is a big market downturn, that client may not really have their best interest served in that type of situation. But then you get to retirement. And that's where, even if you could accept that fee only is quote unquote the fiduciary best way to help people during their accumulation years, it really falls apart in retirement, because it's still this idea of it's all investment oriented. It's the total return retirement income style. Total returns is really just, you take the pre-retirement approach and you apply it post-retirement. And for about a third of the population, that resonates best. But traditionally, like many types of annuities, where the pay was based more on a commission. And that's where the fee only argument is commissions are bad because you're incentivized to accept a commission rather than a fee. But if you think about, and this is just like a made up number, suppose the annuity had a 6% commission to the advisor versus the advisor is going to charge 1% every year on those assets. What's going to cost more to the consumer, a one-time 6% fee or paying 1% every year for the next 20 or 30 years?
That's a good point.
Yeah, it's the fee only model is more expensive. And with the fee only model, a lot of the focus is on you build a model portfolio. You have different asset allocations. So we're going to try to align the risk tolerance. And if the risk tolerance says they should be 60-40 stocks and bonds, well, here's my model portfolio I put together that I think is the best 60-40 portfolio possible. So I'll put you into that portfolio. I'll charge my 1% fee on that every year. That's the basic idea behind the fee only model, but it just speaks to a total returns retirement income style. There's not a role for annuities. There's not really a role for purchasing individual bonds for like bucketing and so forth, or at least it's harder to implement in that approach because advisors can't always charge fees on that if they were commission based. Now there are fee only annuities so that a fee only advisor can use annuities, but still historically many fee only advisors have that sort of bias against annuities. And so they don't have that ability to adapt and use the different retirement income styles. And so that's where if you can be a fee only advisor and still work with all four styles, but as a starting generalized point, the fee only advisor is really most comfortable in the total return style and may not be willing to help clients with those other three retirement income styles.
And there is no truly conflict-free relationship of any kind. Every relationship's going to have some sort of conflict. You can't completely get away from that. I think the fee only advisor might say, well, I don't accept these commissions, but I would refer that business out to a relationship that I have. But of course, how willing are they going to be able to do that if they're taking it out of their base, like you said, that they're charging that 1% fee on? And then you have a whole another issue on your hand because you have to do quality control for a third party that you don't have total control over that portion of the assets any longer. So you're kind of losing some of that quality control there too. But
yeah,
it's just an interesting thought. I think sometimes the fee only gets placed on a pedestal and maybe not necessarily rightfully so.
Right. And yeah, what you mentioned, like if a fee only advisor refers out, they believe their client should say spend $200,000 on an annuity, well, then that's going to move that $200,000 outside the investment portfolio that the advisor manages. And so the advisor can no longer charge their fees on that $200,000. And so, right, that's where a conflict is created, because if the annuity was the right way to go, the fee only advisor is not incentivized to support that decision and may not have the oversight, even if they are trying to do the right thing and refer that business out. They're not able to fully manage that. It's not part of it's not part of their purview at that point.
I've been a proponent of terminology such as fiduciary only or fiduciary always or some sort of language like that, because it kind of drives me nuts with the advisors. If you're able to act as a fiduciary sometimes and then not other times, I think the industry could somehow just have an umbrella of fiduciary at all times, but that might be a little clunky and hard to, I think the industry as a whole, it's kind of slow to make changes, isn't it?
It is. Yeah. And it's complicated too. Like a friend of mine talks about, she gets into the grammar of like nouns and verbs, and advisors charge their fees on verbs, like they're providing advice. And they, as soon as you start talking about nouns, like financial products that may pay based on a commission, it just doesn't work into that advice model as we currently have things structured with the regulatory framework in the United States. So there is room to grow and improve and figure out how to, the idea of fiduciary is very important. It's serve the best interests of your client. it's the simplification that we've seen happen with the regulation in the US is the only way to serve the best interests of your client is if you only accept fees from your client and do not sell them any financial products that you receive a commission on. And that's not necessarily the right approach for retirees.
Yeah, I think the industry still has a long ways to go, but it's hard to say exactly what the correct answer would be. So let me jump into a tax planning question as we kind of get close to wrapping up here with a couple of final questions for you. Tax planning, that's a huge part of what my firm does. A lot of financial firms are not even able to do tax planning, just more so from a compliance standpoint, I suppose. And you get into a gray area of whether or not advisors can even discuss it. But I'm curious, if I asked you, what are some of the most commonly overlooked strategies or maybe misunderstood tax implications? Do you have anything that jumps to mind when I say that?
Oh yeah, this is, aside from the RISA, the area I'm most interested in with research these days is the whole tax planning and how big of an impact there's these factors in the tax code have that people may not recognize in advance when it comes to retirement. That there several things. There's preferential income stacking. Your long-term capital gains and qualified dividends have a different tax rate system, and they stack on top of your ordinary income. And so when you generate ordinary income, you can compound the tax problem because you could push your long-term capital gains from the 0% bracket into the 15% bracket. There's the Social Security tax torpedo. When people start Social Security benefits can be taxed. Up to 85% of the benefit can be taxed, included in your taxable income. And the method used to determine what percent you have to include in your taxable income is extremely complicated and leads to all kinds of weird effects. There's the Medicare issue, where if your income exceeds certain thresholds, that can increase your Medicare premiums per person by close to $1,000 a year at this point. And it's just $1 too much, and you have another $1,000 of Medicare premiums to pay. So it's like that would be 100,000% marginal tax rate on that dollar of income.
Right. What do they call it? A cliff tax, essentially?
Yeah, right. Oh, and also with required minimum distributions that now start at 73, and if you're born in 1960 or later, will start at 75. They can be a real surprise because you kind of have the lifestyle in mind of what you want to spend, and then the RMDs force you to take out a lot more than you want to spend, which is not a problem full by itself because you can just reinvest that in a taxable account. But it can be a problem because it can dramatically push up your taxable income and put you into higher tax brackets. And then we have a widow's penalty or a single person penalty with all this as well, where single people, with the way these factors interact, can have a much more dramatic impact on a single person than a married person. And so one example of that I talk about, suppose you're a single person in retirement, you've got a Social Security benefit, you've got some long-term capital gains, you're at a point where, well, if you were married, you'd still be in the 12% bracket, but because you're single, you're already in the 22% bracket. But then what happens to you is you're at the point where if I take $1 out of my IRA, because it's an RMD or required minimum distribution, whatever the reason, I pay 22% on that, but that's going to push another 85 cents of my Social Security to be taxed at 22%. So I'm now paying 22% on $1.85. And then this is also at the same time pushing $1.85 of my long-term capital gains from the 0% bracket to the 15% bracket. And when you put all that together, this single individual who thought they were in the 22% federal income tax bracket is paying 49.95% tax, or 49.95 cents of tax on that $1 of income. And that's just the federal. That's if there's a state tax on top of that.
Yeah, that's not even taking state into consideration. I think a lot of what I'm hearing you say too, it's a little bit of a domino effect. You can't just say, well, I'm going to move this piece, because if you do, you might accidentally be moving 4 other tax thresholds that you're not even aware of necessarily.
Right. It all interacts, and it's complicated. And so another thing I just generally support is, at least for the high earner in a couple, to think about delaying Social Security to 70. And when you further add this whole tax issue on top of it, it's all the more reason to delay, because then you do these Roth conversions during your 60s, start Social Security at 70, you may be in a much better position to maybe, I've looked at case studies of retirees, people who retire in the early 60s with maybe $2 million of assets. If they just follow conventional spending approaches, it may be unavoidable that they're paying taxes on 85% of their Social Security. But if they do some Roth conversions and things before Social Security begins, it's hard to get the taxation on Social Security down to zero, because the brackets for that have not changed since 1994. They're not inflation adjusted like most of the tax code. So more and more Americans are having to pay tax on some of their Social Security. But if you can get it down so you're only paying tax on 30% of your benefits instead of 85% of your benefits, that can save a lot of money every year and lead to better long-term outcomes.
Yeah, there are some time frames in there that, particularly, like, we're working with retirees. So you have from the date that you retire until you reach Medicare age, if you retire before 65, because then maybe you want to keep your income artificially low to not pay too much for your health insurance, right?
Oh, that's another one. Yeah, the Affordable Care Act subsidies.
So there's that. And then we have the Medicare IRMAA. It's a little goofy because it's always two years lagging.
So at age, if you have an ACA plan at the ages of 63 and 64, you're hit with a double whammy. Your income in those years could lower your ACA premiums or subsidies, the less subsidies this year. And then 2 years later, you might also face higher Medicare premiums too.
Yeah, putting into context a lot of what you were just mentioning, when we're doing some of this tax planning for clients, we're looking at it almost in phases of their life, because they have their retirement age to age 65, which is Medicare age, and then they have their Medicare age to potentially age 70 when they're delaying Social Security, and then 70 to 73 when required minimum distributions began. And then layered on all of top of this, we have our Tax Cuts and Jobs Act that's going to expire after 2025. So there's a lot of moving parts there. We have an enrolled agent in-house on staff, and then we also have leveraged Holistaplan, which is a pretty cool tax software. And that helps put a lot of these conversations into perspective. But man, I mean, just hearing you talk about it too, there's a lot of moving parts there that are tough to get right, because I think we see so many retirees come to us with kind of one idea and say, I've heard, my neighbor told me I got to start doing these Roth conversions, and they want to do a Roth conversion. And it's just kind of totally out of context. It's just saying, let's do a Roth conversion. Well, like you're saying, that could be right move. It could be the wrong move. How much, when to do it. There's a lot that can impact that decision.
Yeah, and just the broader point is that people often think they'll be in a lower tax bracket in retirement. But when you add all these factors together, which didn't apply pre-retirement, like your Social Security benefit taxes and your Medicare surcharges and so forth, you may be surprised that even though you're in the 12 or 22% bracket, which in 2026 is going to return and be 15 or 25%. Even if you are in those brackets, when you add in all these other factors on top of it, your effective marginal tax rate could be quite a bit higher.
Right. Any thoughts when it comes to estate planning or estate taxes? Is there anything interesting on the horizon that to add to the conversation regarding estate taxes?
Well, at the federal level, the thresholds are still pretty high. They could, and they will in 2026 be lowered, but still a very small percentage of Americans have enough wealth. I don't recall it specifically in Iowa if they had the lower estate tax there than the federal levels. But yeah, I mean, just one strategy, if you're worried about that, would be to at least take advantage. If you're comfortable that you're not going to run out of money, which if you're worried about estate taxes, that's kind of a scenario where you're not going to run out of money. At least taking advantage of those gifting limits every year, where you can make gifts up to, I believe in 2023, it's 17,000 per person, or for a couple, 34,000 could be given to one individual. Or if you have 3 children, a married couple could give them each the 34,000 a year. And that's under the limit, so that you don't have to put that on as a formal gift. And so that can be a way to reduce the ultimate value that you may have to pay the estate tax on, because the estate tax is pretty big. It gets up to 40% once you're at $1 million over the limit.
Yeah, you kind of get taxed throughout your whole life, and then you get that one last, well, for those that are fortunate to have a larger portfolio that they're trying to pass along, that one last hit.
But yeah, it's for a couple right now, we're talking about like $22 million before this is an issue. Though it's not always been that high, and it may not be that high in the future. So
I forget what it drops back down to. I mean, automatically, if they did not do anything with the Tax Cuts and Jobs Act, is it 5 million? I forget.
per person, it's that, like, it would be half of the 5.5 or 6 million per person, or like
Okay.
11 or 12 million for a couple in 2026. And that would all be inflation adjusted from the 2017 levels.
Well, as we kind of start to wrap up here, so you've spoken at a lot of different conferences. Doesn't sound like you've done as much traveling as of late, but you've spoken at a lot of conferences, probably been interviewed more times than you can count. Is there a question that you've never been asked that you'd like to share a perspective about?
A question that I've never been asked. It seems like at this point I've heard all the questions, although sometimes I still get new questions, but no, I think we had a pretty good discussion. We covered quite a bit, and hopefully I'll be able to speak again in Iowa at some point. I have spoken there a few times with like the local Financial Planning Association chapter, and I know there's more than that, but right now I'm blanking on what other chances I've had. But yeah, it's been great talking with you.
Wade, thank you so much for joining me and sharing your wisdom with our audience. I truly appreciate it. And it's been cool getting to know you and not just read your books and take your courses, but be able to speak with you as well.
Yeah, likewise. It's been a pleasure. And I'm glad I got to meet you at that event in Kansas City. And yeah, it's good to talk to you.
That will wrap things up on my conversation with Wade Pfau. I hope you enjoyed it and learned a few things. Wade is truly one of those guys that you can throw just about any financial related question his way, and he has a thoughtful, intelligent response without having to do a lick of additional research. So I really enjoy these conversations with Wade, and perhaps we'll even have him on again in the future, especially if we get some more listener questions that we can fire his direction. I went ahead and added the RISA link in the show notes for this one again, so if you did not take advantage of that last time after listening to the previous episode, be sure to go ahead and do that this time. You can find all past episodes by visiting our website at integrityguidance.com. Just go to the podcast tab, or you can listen on your phone through just about any podcast app. So that's all for today. Come back again in just 2 weeks for another episode. God bless.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.